Good afternoon and welcome to the Belvoir Preliminary Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Louise George, CFO, and Dorian Gonzalez, CEO. Good afternoon.
Hi there, Mark. Thank you very much for the very kind introduction, and good afternoon, everyone. Firstly, thank you in advance for listening to our presentation. Normally the presentation is about 40 minutes, and Louise and I do it between us. So I do the sort of first section, then Louise does the middle section, the financial section, then I do the third section, then we come back together as a sort of, two partners in crime together at the end to answer any questions that you may have. If you've sort of met with us in an arena like this in the past, you'll know that we're happy to answer questions on pretty much any part of the business or the market as a whole. Okay, so into the main presentation. Well, last year was a particularly good year for us. The market was very active, and later on in the presentation, I'll sort of talk about the market, the lettings market, and also the sales market, and also the mortgage market, just to give you a sort of understanding of where we are with our thinking and the likely direction of the market. And to begin with, I'll just do a brief introduction. If you can pass me on to slide 2, please. Thanks, please. So firstly, it's Dorian speaking. 24 years experience in property, 17 years with Belvoir. I'm just coming into my 18th year. Louise, 20 years experience as a board member on AIM listed companies, and 8 years with Belvoir. When I think back to sort of what the business looked like 8 years ago, we only had one brand. It was just Belvoir. We were only involved in residential lettings, so we had no involvement at all in property sales or financial services. A very different business, and I'll explain that in slightly more detail on the next slide. We both have shares in the business, and we have both increased our holding over the last 12 months, and we both have share options going forward. So that's just an introduction to us both. Okay, so what I'll do is on this slide. This really is an illustration of what the business looks like and our trading style. So I've got sort of two screens here, so I sometimes look at mine and sometimes look at this one. But at the top, I hope you like our sort of new red and blue branding. Louise has been working very hard on this sort of new brand concept over the last few months. And the reason that we wanted to incorporate a new brand into the Belvoir Group Topco is just to make it look different, really, to the Belvoir branded franchisees. So you can see how Belvoir looks, our traditional brand, and Belvoir Group now has new branding, a new logo, a new font, and a new colour scheme. So I really like it. All credit to Louise for making that happen with our designers. So on this slide, you've got Belvoir Group at the top, and then you've got the next line down, our trading styles. So starting off with sort of Belvoir on the left-hand side. So that was our first brand when we IPO'd. We IPO'd as Belvoir. We didn't have any other brands. And Belvoir is a network of 158 franchised offices. We own and operate one of the Belvoir offices. It's in Grantham. It's very easy for us to manage, and we've always owned a Belvoir franchise. And Belvoir is primarily a residential lettings business. So in a normal year, around 90% of the revenue generated within Belvoir comes from residential lettings, so it's recurring. It's that safe, recurring element of revenue, and about 10% comes from estate agency. That's very similar to Northwood, and I'll come back to Newton Fallowell in a second. So Northwood, very similar. We acquired the Northwood business in 2016. 93 office network, and 90% of the revenue that flows through Northwood, exactly the same as Belvoir, is derived from residential lettings. Northwood has its own USP. They sell a product to landlords called guaranteed rent. or primary tenancy, and that's where the franchisee essentially rents the property from the landlord and then sublets by means of primary tenancy arrangements. It offers a very safe way of letting for the landlords, appeals to people who just want a guaranteed level of income flow. So again, it's called guaranteed rent. Even if there is a gap in tenants, the landlord still receives their rent. It's a good proposition if you're a landlord who's looking for sort of guarantees and assurances and you're more risk averse. So Northwood, very similar to Belvoir, but does have different products. Newton Fallowell, sort of sandwiched in the middle, is a little bit similar to Lavelle in that it's a very strong East Midlands-based estate agency business. So Newton Fallowell was our first foray into operating a multi-brand business. We acquired the business in 2015. All of the Newton Fallowell offices are within an hour's drive of Grantham, so it's very much an East Midlands business, and that's similar to Lavelle. We acquired the Lavelle business in 2020. Lavelle operates within the confines of Lincolnshire boundaries. It's a Lincolnshire business, 16 good offices, and different to Belvoir and Northwood, Newton Fallowell and Lavelle are 70 to 80% estate agency revenue with a much smaller element of lettings. Then came Humphreys. Partway through last year, we acquired primarily a franchise network. So of the 20 offices, 17 are franchised, 3 are corporate. We acquired this business from Nicholas Humphreys himself. And the revenue split is 87% of the revenue that flows through Humphreys is recurring, it's lettings, and 13% is other revenue, i.e. estate agency and other bits and pieces. The key difference between Humphreys and Belvoir and Northwood is that Humphreys is a student lettings business. So that's an area that we do wish to expand in the future. We don't particularly wish to expand it within the Belvoir and Northwood brands. A lot of franchisees, when they become very good at residential lettings, they don't want to give the impression to their landlords that their beautiful 3 or 4 bedroom property is about to be filled with a pile of students. So therefore, a lot of our franchisees just choose not to transact with student lets within sort of Belvoir and Northwood. So we intend to grow student lettings under the Humphreys brand, and hopefully that makes sense. Nottingham Building Society is a little bit more complicated to understand. We first entered into a relationship with the Nottingham Building Society to dual brand their offices and to offer estate agency and letting services to their clients. That was the first step of the process, and we are now dual branded with 37 Nottingham Building Society branches. Since then, we've deepened the relationship, which I'll cover on the next slide. Under the line, so the next line down, we have our mortgage business. So our mortgage business consists of, very similar to franchising, consists of 100 individual businesses with 250 advisors who sit within those businesses. So very similar to a franchise network. The 243 mortgage advisors, as it was at year end, it's now 250, are our mortgage advisors. So they are either self-employed as part of one of these businesses, or they are directly employed by us and then deployed into a sort of franchise business or into NBS or into somewhere else. So either payroll or self-employed. And there is a difference in the two models. But essentially, we've now got 100 businesses, 250 mortgage advisors. We haven't reached the ceiling of growth on the financial services side. We still think we can take FS much further on the basis that, you know, we've grown to 250 mortgage advisors from a standing start in 2017. So it's going really well for us, but there's so much more we can do with it. Okay, so just to add a little bit of colour around the acquisitions. So Humphreys, I've pretty much covered, apart from the consideration was 4 million net of cash. It added 2.1 million of revenue last year and 0.5 million of profit before tax to the group, which we're very pleased about. We brought on another 6,250 managed properties, and it's another business that has recurring revenue. So specialist in student lettings, good acquisition. It delivered exactly what we wanted it to deliver, and going forward, we intend to grow the footprint of Humphreys. Nottingham Building Society. So on the first slide, I said that we were occupying 37 of the NBS branches. We've also acquired NBS's mortgage advisory arm. We acquired their mortgage services business in July of last year. It was 21 mortgage advisors. Some of you may remember this. 21 advisors plus 6 support staff. Since then, the business is going well, so it's added £500,000 of revenue and £0.1 million of profit before tax. So not a huge acquisition, relatively small, but it's given us access strategically to 50,000 savers who are saving money with a bit of government top-up in accounts that then can be used for either a deposit on a property or a pension long term. But we suspect that a lot of these LISA savers will want a mortgage, which we are now exclusively providing mortgage products to NBS clients, and these LISA savers will also want to buy a property, and we have sort of around 90 franchisees around the East Midlands area where NBS is based, transacting in properties, so we can hit it from 2 different directions. Quite a unique arrangement which is a unique arrangement in our sector. The third one, which one of the questions actually that we've had come through a few minutes ago was about this. So the Mr. and Mrs. Clark business. So just to explain the logic around this. So firstly, what is it? Well, we have acquired Mr. and Mrs. Clark, the brand, and we have also acquired Mr. and Mrs. Clark, the people. So it's Paul and Alex Clark. They've signed on for a long period, so for at least 3 years. We've bought their business from them, and we're now heavily incentivizing them to grow, using our support, using our systems, using some of our people, and using our access to sort of leads and expertise. We're going to grow this business over the next 3 years. So the logic behind doing this deal is that we have, in my opinion, built a brilliant property franchise business. Franchisees now are averaging a turnover from a retail unit of £321,000 a year. They're paying, let's say, anywhere between 10,000 and 30,000 to occupy a retail unit. The model works really well. It's been tested in all sorts of markets. It's been tested against COVID. We traded successfully through the financial crash, etc., etc. So we know our property franchise model is extremely robust and it continues to grow. But the inherent weakness that we had in our model is that the entry level, at the cost entry level for a new franchisee who loves what we do, if they then wanted to come and join us, to invest in a cold start, the costs had sort of risen to maybe 150,000 or even higher to cold start as a Belvoir or a Northwood or a Newton Fallowell, and to buy a resale. We've had resales changing hands at kind of 1.5, 1.6 million. Costs have just reached, not all of them. You can get a resale for much lower than that. But point being, the cost of entry was pretty high. So we kind of wanted a lower cost entry point where franchisees will be attracted. If they're attracted to join the network, they can join via the route of Mr. and Mrs. Clark. That is the long and short of the logic behind it. It's a lovely brand. It's a lovely business. If you have a look at their website, they are called the Instagram estate agency business. It's all about customer services. Branding is very strong, and as a concept, it's been featured in all of the sort of daily newspapers, Telegraph, Times, Mail, etc. So it is worth, if you get time, have a quick look on the website. So just a few key highlights before I pass across to Louise. So financial highlights, I'm sure you've read the RNS, but just a few sort of pull-outs. Revenue up 37%, 29.6 million. Profit before tax up to 9.3 million, so that's 39% up on 2020. Earnings per share up 35% to 20.4 pence, and over the last 5 years, EPS has increased by 260%, so pretty significant. Net debt, I remember when the first lockdown happened, net debt was around sort of 7 or 8 million at that point, and net debt has sort of come down very quickly over the last 2 years. It was down to 1.3 million at the end of the year. It's actually now down to more like 500,000 after 2 or 3 decent months of trading. but as you can see, with the balance sheet is, we're in a strong position. We are still acquisitive. We are still looking for corporate acquisitions. So it may be that we use our cash for further acquisitions this year in our usual sort of careful and measured way, but maybe not. But ultimately, the net debt position is significantly down. Operational highlights. We're very pleased to say that we have continued to increase our footprint of offices. So we're now at 463, which is 11% up on 2020. Financial advisors, I've mentioned, 20% increase on last year, and we will continue to grow our our financial advisor, mortgage advisor footprint this year. As I say, we're sort of viewing financial services as a land of opportunity, really. There are acquisition opportunities out there, so we will continue to expand this footprint this year. House sales. Now, clearly the house sales market, and I'll talk more about the market itself later on, but the house sales market has been very buoyant for the last 18 months. You'll fully accept that. And last year, across the whole of the UK, there was 20% more transactions took place last year compared with a normal year. We grew our house sales by 54% last year, and we're very pleased with that outcome. And I always sort of smile when I see the number, 12,000 house sales, because we haven't been selling properties for that long. As I say, when we floated, we didn't have any involvement in estate agencies, so good result all around. I'm also very pleased to say that managed properties, which is the element of our business that provides recurring revenue. It's always very important to investors and institutions. We grew out. So even though all of the action last year seemed to be around property sales and property transactions and house prices, despite all of that, we still grew our managed portfolio by 12%, up to 72,900. And I'll talk about sort of lettings a little bit later on. Over to you, Louise.
Thank you, Dorian. So over to the financial review. Starting off with our group statement of comprehensive income, you can see here that our revenue is up 37%. If we drill down into the property division, the property division was up 27%. And of that, the acquisition of Nicholas Humphreys, which was right at the end of March, so we had 9 months worth of benefit, added 11%, and the like-for-like growth was 16%. On the financial services side, we saw revenue up at 49%. And once again, if we drill down into that, the acquisition of Nottingham Mortgage Services added 5%. We only owned that from right at the end of July, so we had 5 months of that in 2021. And then like-for-like growth saw the financial services business grow by 44%. Gross profit was up 29% to 19 million. And one of the things I've highlighted on the page here is the gross profit margin. You can see that's gone down a little bit. Meanwhile, the operating profit margin has gone up a little. This kind of reflects the growing financial services business. So our financial services business is kind of in 2 parts, if you like. We've got a kind of a financial services head office up in Barnsley, where we have a number of employed advisors, and indeed the advisors down at the Nottingham Building Society are employed. But the bigger growing part of the business is from what we call our business partners. They operate more like a franchise network, so they manage their own business, they manage their own admin around chasing up their mortgage deals, and we just effectively provide some business development. So they're much more, they earn a higher rate because they're more self-sufficient, and they require much less admin, so that has that impact on those 2 margins. The net profit was up 39% to 9.3 million. And the last point to highlight here is the announcement of the increase in the corporation tax in 2023 actually increased the deferred tax, the potential deferred tax, increase the charge against tax in 2021. But there was a mitigating credit on corporation tax from the exercise of share options by management, because the price at the end of 2020 on which the deferred tax asset was based was 151.5, and during the year we saw the share price increase quite substantially. So if I move on to the our financial highlights, the group revenue increased by 7.9 million to 20.6 million. Of that 7.9, Nicholas Humphreys had added 2.1. The Nottingham Mortgage Services had added 0.5. Meanwhile, those of you who've been following us certainly for more than 12 months now might recall that last year we talked about the acquisition of Lavelle. That had come with 5 corporate offices, which we managed to franchise out between August 2020 and January 2021. When we look at, obviously, when you own them corporately, you've got the if you like, the gross sales value coming through. But once they're franchised, you know, we're receiving the sort of MSF, which might be 10% or 12%. So our revenue, as a result of having franchised out those corporate offices, fell by 800,000. But likewise, you can see on the other side of the page, the costs also fell by 800,000, as we didn't have the running costs of the staff and the offices themselves. So going back to the revenue, the like-for-like growth was actually 6.1 million. Within our group revenue, the key income stream for franchisees is the management service fees, that's MSF. That increased by 1.6 million. Within that, lettings was up by 700,000, of which 400,000 was organic growth. And on the sales side, we saw MSF up 900,000, and that was predominantly organic growth. The corporate office income, the movement in that became increasingly complicated by the fact that we'd added 3 corporate offices when we acquired Nicholas Humphreys, and then we franchised out the Lavelle corporate offices. But if we actually distill it down and look on a like-for-like basis, 400,000 of the increase came from growth in the 2 corporate offices that we own in Grantham. On the cost side, costs increased by 1.5 million. The acquisitions added 1.8 million to the cost base, plus a further 200,000 of professional fees associated with the acquisitions. We saw costs go down by 800,000 from having franchised out the Lavelle corporate offices, and also the share-based payment charge was £200,000 less than it was in the previous year. So when we take all those into account, the underlying overheads had actually increased by £500,000 compared to 2020. But if we go back and compare to 2019, they were up just £100,000. Operating profit was up 2.7 million to 9.3 million. And just a final point on this slide, the final dividend is proposed to be 4.5 pence. That gives a total dividend of 8.5 pence, which is 18% up on the 7.2 pence from 2020. And when I say 7.2, what I'm not including in that is the element of catch-up that was settled in 2020 as a result of stopping the dividend in the previous year. So we tried to we introduce a bit of new information for shareholders to try and give you a flavour of how the business has grown in terms of gross profit across the 3 main revenue streams, and to give some flavour of how they've been impacted by our acquisition strategy. As you can see, their list of acquisitions right back from 2015 to date, you know, have obviously have had a positive impact on our growth, but this is a way of demonstrating some of the organic growth as well. So if we hark back to 2012, when Belvoir floated, as Doreen said earlier, it was just Belvoir as a brand, and it was only doing lettings, hence the single red line there. In 2013, we actually introduced a little bit of sales to our Belvoir franchisees, which grew a little bit further in 2014. In 2015, that was when we made our first acquisition. That was at Newton Fallowell, which was an estate agency chain predominantly. And then so you can see the growth in 2016, we added Northwood. So you can see quite a big step up on the letting side then. And the little bit of financial services in 2016 actually arose from the Newton Fallowell network, where they had a handful of advisors. But we really started to see financial services ramp up from the middle of 2017 onwards, when we acquired Brook Financial Services. So you can start to see here how the diversification into sales and financial services has helped to grow the business. But if I draw a line in 2014 and look at gross profit, then it was 6.5 million. And in 2021, that was up 192% to 19 million. So that was growth of 12.5 million over that 7 years to 2021. If we take gross profit as acquired, i.e. the gross profit that those businesses we acquired were doing at the point when we acquired them, that would have added 8.4 million, i.e. 129% to the 2014 number. So that means that organic growth has actually accounted for 4.1 million of growth over that period, which was the remaining 63%. So broadly, we can see that the underlying business has grown by around 9% per year. So going on to the balance sheet, our balance sheet intangibles have increased as a result of the 2 acquisitions that we've done. The other area to analyse to sort of draw out is the unearned indemnity commission balances. We've got an asset of 2.2 million. 1.6 of that is funds commission that Mortgage Advice Bureau themselves retain in a bank account with our name on it within their control. That's it, if you like, their security should there be a big clawback of commission. So this clawback, it arises if we sell a life protection policy. We earn the commission up front, but if the client cancels that policy within 4 years, then there would be a clawback of any remaining commission on a straight line basis. So MAB retain it, give them some comfort. Meanwhile, we recognise our assessment of the liability, which was 1.5 million at the end of December 21. That's what, based on historical experience, what we think could get clawed back. And of that 1.5 million, we do have the ability to recover 600,000 from our advisors. So those 3 elements are reflected in the balance sheet. Deferred tax is up from 1.4 million to 2.9 million. This is a result of there's an extra 600,000 arising on the 2021 acquisitions, and a further 500,000 arising from the change in the corporation tax to 25%. That's had that impact on the deferred tax. Net debt, our cash, we had cash of 7.4 million at the end of the year. The bank debt was down to 8.7, and therefore the net debt was actually down to 1.3 million. If I look at our bank balance as of Friday, it was 8.3 million, which means that our net debt as of Friday was at 0.4. The board is mindful that we have a final balloon payment on our bank loan of 7.9 million in March 2023. As things stand, we could settle that in cash at that point in time, subject to not finding anything more interesting to do with the cash between now and then. The bank is very supportive of us and definitely would be interested in renewing that facility if we wanted to do that, or perhaps putting in place a revolving credit facility to give us the capacity to make the sort of acquisitions that we've done over the last few years. So on the cash flow, highly cash generative, 100% of EBITDA converting into cash. This has enabled us to acquire the 2 businesses we did last year, Nicholas Humphreys and Nottingham Mortgage Services, for 4.4 million in cash. We also continue to support our franchisees under our assisted acquisition programme. We granted loans of just under £800,000 to franchisees to support that sort of activity. Meanwhile, actually, we had repayments into that loan book of £1 million, so a net inflow. We hope that this year we'll see an increase in the assisted acquisitions activity, and we'll be able to ramp up our lending to franchisees. On the financing activities, there was a cash inflow of £1 million from proceeds of shares issued to satisfy the exercise of share options during the year. And the dividends were 3.3 million, and that included a catch-up of £500,000 on the final 2019 dividend that had been suspended in 2020. Just a final slide from me before I hand you back to Dorian. So we've done a lot of work over the year to develop an ESG strategy for the group. We conducted a materiality assessment, which involved talking to quite a number of our key stakeholders, franchisees, employees, investors, our local council, to get some perspective of what was important to the community. and legislators. I can't say that. So we've built, from using that feedback, we've built up 5 pillars that we're going to start to gather metrics on and set different targets. And we will, it's reported on in a lot more detail in the annual report, what we're looking to measure under each of those pillars, and we'll be reporting on that going forwards. But I think what's been quite refreshing as we've done this exercise, it's interesting because Belvoir as a company, if you like, we don't have a big environmental footprint. We don't have loads of offices. We don't have, we had 200 staff. We don't have 2,000 staff. We don't have a big fleet of cars. So our footprint as a company is quite small. But of course, when you look at the wider group and look at our franchisees, there is a potential there to have a bigger impact by engaging with our franchisees and encouraging them to come on board. And I think with the discussions we've had with them have been really positive. I think they'd be pleased for us to give them a steer in some of the ways in which they can improve their ESG performance. So on that note, I shall pass you back to Dorian. Thank you.
Brilliant. Thanks, Louise. Let's look right. So yeah, back on. So we've got a couple of slides here, really just to run through some operational highlights on both lettings and sales. The next one is some operational highlights on mortgages, and then just after that, I've got sort of 2 or 3 slides on the market itself, because that always sort of people always ask sort of questions around what's happening with the market, etc. So we'll cover that too, and then towards the end I'll do a quick wrap up, and then we'll make sure we cover any of the questions that have been asked. So operational highlights on the letting and sales side. I sort of covered some of these points, so I'm not going to go through it line by line, but there are a couple of pull-outs. So one of the pull-outs is MSF management service fees, the fee that is charged by the franchisor to the franchisee. It's normally a percentage of revenue, either 10 or 12%, and a franchisee pays the franchisor this percentage in return for the services that the franchisor provides. So, very pleased to say that average MSF per franchise office is up 13% to £33,360. We haven't put our franchise fees up. So this is simply off the back of, and this is really where franchising can work very well. So our MSF income is going up off the back of franchisees growing. So it's a relationship that works very well for both parties. Our lettings and sales ratio. So if you look at our total revenue of 29 million, around half of it comes from financial services, or just less than half, and the other half comes from property services. So if you just look at the property services revenue, the ratio of lettings and sales last year dropped to 74-26. It's normally sort of 80-20, and we are expecting it to revert back to 80-20 as the sales market returns to normal sort of later this year. So it's a very comfortable level. It's good for us as a business. If our property services revenue, if 80% of our property revenue is recurring, then it just means that we're in a pretty strong position as always. So that ratio, actually the 80-20 ratio, has been the same for actually as long as I can remember. So it's at least the last 7 or 8 years. So a few sort of interesting franchise stats. So the average revenue per franchisee is now at 321,000. We've got 8 offices exceeding $1 million of revenue, with the largest at 1.5. And these 8 offices are single units, just one shop, one team of people, generating over $1 million of revenue in any one year, with the largest at 1.5. In addition to that, we've got 20 franchise owners who may own a collective of 2 or 3 franchises each. So 20 franchise owners exceed $1 million of revenue, with the largest at 1.9 million. And we've got a little clutch of franchisees at just shy of sort of 1.9 million, who are sort of pushing to get to the 2 million mark, which would be quite a significant milestone for us. So the property franchise concept is working exceptionally well. 58 franchisees have 2 or more offices. 18 have 3 or more. So we've also put a stat in here. So 59% of our traditional lettings franchises, i.e. Belvoir and Northwood, were actively selling houses in 2021. So if you flip that around, it means that 41% of Belvoir and Northwood franchises had no involvement in a estate agency last year, which is entirely correct. They are two different businesses, lettings and sales. Some franchisees just don't want to be involved in a estate agency. They prefer to concentrate on lettings, which is, very technically sort of intense area of property, and that's their prerogative. And it's our job to encourage them to get interested and get involved in estate agency and financial services longer term. So on to sort of operational highlights on financial services. Again, I won't go through this line by line. We arranged 16,500 mortgages last year. That's 37% up on the previous year. Lending across all of those mortgages was 2.8 billion. So if you're particularly fast with a calculator, you'll work out that an average mortgage is about £170,000. We started financial services in 2017, and we're very pleased that it now contributes 3.8 million of gross profit to the business, and we think we can take this much further still. On the right-hand side, we've got a few areas of focus for 2022. Life policies to mortgages. We're going to focus on the penetration of those sales. The reason that life policies to mortgages were slightly down last year was that advisors concentrated more on new business than on the sale of additional products, which in some ways is understandable, but that's an area of focus this year. We're going to grow the footprint again this year of advisors, and we're going to concentrate on obtaining more mortgage business from our existing franchise networks. There's some of the, the operational challenges that we've got this year. So general market update on lettings. So if I'll talk about the sales market on the next slide. So if I could sort of condense my thinking into to try and explain what's happening with the rental market at the moment. Well, I think the easiest way to explain it is to use the word shortage, i.e. shortage of stock, and to say that rents are increasing at a rate that we haven't seen before. And I'll put some colour around that, and I'll also explain why I think that's happening. So there are three different ways to measure rental inflation. So the portals, i.e. Rightmove and Zoopla, every month report on rental inflation, which is data that's collected from advertised properties. So that's one way of measuring rental inflation, by looking at the indexes created by Rightmove and Zoopla. The indexes at the moment, the portal indexes, are reporting that rents are increasing compared with 12 months ago by around 10% in most areas. But that's at the point of a property being advertised. It may be a different story as the property is let. So the second way of measuring rental inflation is to measure the data at the point at which a tenancy is created. So when a tenancy is referenced, you can measure rental inflation, or the rent level at that point, which is measured generally by our referencing provider. So we're reporting that rents are increasing compared with 12 months ago at the point of reference by 8.6%. So quite significant. The other way of measuring rental inflation is how ONS measure rental inflation. That's they attempt to measure rental inflation across existing tenancies, which is notoriously difficult to do because nothing's happening apart from a tenant is paying rent to a landlord. That landlord may not use an agent, for example. So how do you track that? And ONS are reporting that they usually report that rents are going up each year by somewhere between 1 and 1.5%. That's been the norm for the last 5 or 6 years. They're now reporting that rents on existing tenancies are going up by 2.3%, and I suggest that figure is only going in one direction as this 8.6% starts to be pulled through to existing tenancies. The reason that that's happening in the rental sector, I think this is probably underreported at the moment, is that if you look back over the last 5 years, our population has increased by 1.5 million. Government have put a huge emphasis behind home ownership and driving first-time buyers and increasing the number of dwellings under home ownership, and they've succeeded on that side. So over the last 5 years, the government has helped create 1.2 additional dwellings that are owned by homeowners, so plus 1.2 million dwellings under home ownership. During that same period, the number of properties in the private rented sector has come down by 100,000 units. So it's come down from 4.5 million to 4.4 million. That drop actually happened in 2016, and from 2017 it stayed the same at 4.4 million. So point being, government, I've said this time and time again, that government aren't looking to push landlords out of the sector. 4 or 5 years ago, government was just looking to take the fizz out of buy-to-let and to discourage landlords from entering the sector, which they've done. But now we're reaching a point where demand is way outstripping supply. And to put a bit of context around that, in March, Zoopla said that demand for rental properties across their portal was 76% higher than their 3-year rolling average. That's in March this year. And that's set against the number of available properties to rent on Zoopla is 15% down compared with a 3-year rolling average. So demand vastly up, supply slightly down, and the end result is that tenants are now paying 8 to 10% higher for properties if they want to secure one. Is that sustainable? Will it continue? The questions, I guess, will all sort of mull around. But the bottom line is there is just such huge demand for rental stock that I don't see anything particularly changing unless the supply of properties is increased. So on to house sales. So really what this chart shows is the number of transactions, the number of properties sold in the UK going back to 2006, broken down year by year. So you can see back in 2006 and 7, transaction volumes were very high, 1.6, 1.7 million. Transaction numbers fell. They didn't fall. They fell off a cliff, but didn't fall to zero. They sort of fell to 900,000 in 2008, and to just shy of that in 2009. Then it starts to pick up from that point, and it sort of built up ahead of steam up until 2014, and the number of transactions sort of plateaued at about 1.2 million a year, and it's about 1.2 million transactions that the sector tends to view as being normal. So 2020 and 2021 weren't normal, according to the chart, as you can see. 2020 there were fewer transactions, so the number dropped to it's actually about 1,050,000 transactions thereabouts, and then in 2021 you can see it shoots up to 1.5 million transactions, so 20% higher than the norm. So really that in a nutshell is what's happened in terms of transaction numbers last year. There were 20% more transactions last year than in a normal year. I'm very pleased to say that group revenue was 49% up last year, which is a great result. What comes next? In my opinion, I think transactions this year will be back down to 1.2 million. I think there are some optimistic commentators who feel that sort of 1.5 million transactions is the new normal. I disagree with that. I think we'll fall back to sort of 1.2 million, back to normal market conditions. Coupled with that, house prices last year went up by 10.8%. The previous year it was about 8.5%. Prior year to that, it was 2.5%. So I don't think we've seen stratospheric price increases, certainly nothing like the decade before 2007. And house prices in Q1 this year seem to be softening and falling back to sort of 7.5% increases. I imagine that will fall back to sort of 5% this year. So what we're saying is 1.2 million transactions is very likely this year, back to normal, and house price inflation falling back to around 5%. That's our sort of forecast. Okay, so mortgages on this graph here. This is the final sort of market slide. So in blue we've got house purchase mortgages, and you can see strong upward sort of curve. Then they start to fall back as the stamp duty holiday comes to an end, and then they start to sort of level off. December, clearly there's always a tail off, and then you can see the red line, which is remortgages, starts to climb, especially towards the back end of last year. And anybody who listened to a similar presentation from us in September last year would have heard me say that if interest rates start to push up any further, our mortgage advisors will probably be trampled in the stampede of sort of mortgage holders who are looking to fix their mortgage rates, and that's kind of happening. So we are seeing much more traffic on the remortgage side, as you can see from the chart. But we've had great performance from FS in our business, and that will continue again this year. So in a nutshell, why invest? Well, you all know that I'm very passionate about franchising. I think it's a brilliant business model when it's done well. Our franchisees finished last year with a very strong balance sheet. That a lot of them are sitting on cash. They're very acquisition hungry, and they're very hungry to grow their business off the back of what's been a very successful sort of 18 months for them. We have achieved 25 years of unbroken profit growth, and there's actually a really lovely question which I'll answer shortly about this. So it's 25 years unbroken profit growth with EPS up 260% in 5 years. As I'm sure you're aware, we've got a very stable management team, so 29 years average industry experience. Louise and I have been on board for many, many years and intend to continue in that way. We're underpinned by recurring revenue, so 56% of our gross profit comes from residential lettings, which continues to flow through our business even if our doors are closed. We've diversified very successfully into financial services to such an extent that the gross profit contribution is significant at 3.8 million, and then we continue to be very acquisition hungry. So when I say acquisition hungry, we'll continue to help franchisees to acquire their own competitors, so that actually has started off pretty well for us at the start of this year. We're also very hungry for more acquisitions at corporate level, and it's likely that we will be involved in more sort of corporate acquisitions this year. Then other areas for growth, franchisees are continuing to grow well. We've already said to the market that, well, this week we're saying to the market that we're so far in 2022 we are in line with our expectations. So we've had a decent start to the year, and we'll continue to look for high quality, good businesses that will fit within our sort of stable of brands, but we'll continue to do it in a sort of careful and measured way. Every one of our acquisitions has delivered on exactly what we said it was going to deliver, and we'll continue in that sort of careful, measured way going forward. So that really is the end of the official slide deck. And so I've got a few questions here which I'm going to start to tackle. So first off is the first question that came in before today's event. It was a pre-submitted one from Jake. Jake said, would Belvoir ever consider acquiring a non-franchised estate agency group and keep it that way? You could also say, would we consider acquiring a non-franchised lettings agency group or even FS group and keep it that way? And the short answer is yes. We would consider that. It's not core to our strategy, Jake, because our core DNA is to operate as a franchise business. We're good at franchising. We know it works well. It's been tested in virtually every market, and it's franchising is what we do. But that doesn't mean that we can't necessarily run a sort of corporate network if we chose to do so. So short answer is yes. Another question came in from Richard, who said, Richard S., congratulations on the result, Dorian. Given your superb track record, even growth during COVID, is it really likely that you will stop your 25-year unbeaten track record of revenue and profit growth, as the forecast suggests that you will? Well, I think, we did have an exceptionally good year last year, and that was, partially due to prevailing sort of market conditions and government intervention, with a stamp duty, with the tax break, and tax breaks like that always create just a wave of distortion at the time, positive distortion, but distortion nonetheless. So that might knock a hole in our sort of, our 25-year unbeaten track record. However, I'd say it's really everything to play for. We're really going to fight hard to continue with our unbeaten track record, and we do have the fight in us. So we're going to fight the fight this year, I think, is the best way to answer that, Richard. Second answer from Richard about interest rates. What's the best environment for the mortgage side of the business? Is it sort of a low rate environment, a higher rate environment, or volatile sort of rates? Actually, I guess lower rates, lower to mid rates, I guess, is a sensible answer to that, Richard. But actually, we kind of want to see that house transactions continue at sort of previous levels. So I'll actually be really pleased if house transactions fall back to 1.2 million, i.e. a level of normality. Look what we've done with the estate agency over the last 2 years in that normal environment. We've benefited more so over the last 18 months because of the tax break, but prior to that, our estate agency business was doing really well. So I guess, yeah, low to kind of mid, but we do like a normal estate agency environment. So James M has asked a question. If a franchisee wants to leave Belvoir and go to a competitor, let's say because they didn't like the management, God forbid, or thought you weren't doing a good job, how easy would it be for them to do that, and how tied in are the franchisees? So again, good question about the technical side of franchising. So if I pick a Belvoir franchisee who's grown, let's say, a business from zero to a turnover of £500,000 with 500 or 600 clients. Let's say that's the typical, a Belvoir franchisee. If that Belvoir franchisee wants to exit from Belvoir, aside from death or incapacity, the franchisee has the right to sell that business, but they can only sell that business as an ongoing franchise. So they exit, a new buyer comes along, a new buyer is trained by us, and then we manage that new franchisee the same as we sort of worked alongside the previous franchisee. That's their only ability to sell that business. The franchisee also they don't have the right to do this, a contractual right, but we would certainly consider it if they asked us. And what I'm coming to is a franchisee could, in theory, hand the business over to us for no remuneration at all. They could say, look, I've had enough, here are the keys, I just can't carry on. And in some, we have had situations like this over, in our history, because it's a people business and things happen to people. But why a franchisee would want to give away a business that's worth £500,000 in the scenario I've just described, franchisees tend not to do that for obvious reasons. So if they want the money for the business, the best option is to sell and go and do something else. There is no ability. There's no ability for a franchisee to leave and go to a competitor. It doesn't exist. So the goodwill of that particular franchise that I described is owned by the franchisor. It's vested in the franchisee while the franchisee has a valid franchise agreement. If the agreement is terminated for any reason, i.e. the franchisee wants to leave and go to a competitor, the goodwill reverts back to the franchisor. It's owned by the franchisor. It can't be sold in that way. So hopefully that answers your question. We are very good with technical franchising. We've done it for a long time, and we have seen pretty much, I don't want to say every single scenario, but certainly most scenarios. So Mark A has asked, he said, great progress. What's the pipeline like for further M&A? So again, good question. There are two types of M&A that we're involved in. One is the franchise acquisition side. And we built up a sort of really good head of steam up until 2019 with franchisee acquisitions. And a franchisee acquisition is simply where we help a franchisee to acquire one of their competitors. They close the competitor down, bring the book of business across. They don't port all of the costs across, just the revenue plus some costs. So it's very profitable for the franchisee to do that. And then the franchisee pays to us either 10 or 20% of the revenue that new acquisition generates. So it's very profitable for everyone concerned, and we want to do as many as we can of them. So in 2019, we helped franchisees to buy in around 6 million of extra revenue by means of acquisition. That then fell off a cliff in 2020 and 2021. We were caught in 2020. Clearly, franchisees didn't want to acquire for obvious reasons, and sellers didn't necessarily want to sell at that point, again, for obvious reasons. So then the market changed and became very busy in 2021, and we had the opposite problem where sellers were saying, well, hold on a second, I'll just make lots of money during this year, thank you. Then I'll sell my business for a higher price the following year. So we couldn't do deals during that period for that reason. What's happened in the first quarter of this year? So we did about 1 million of franchisee acquisitions. last year and the year before. Bear in mind that I want to be at about 6 million a year. What's happened in sort of quarter one this year is that we've already completed on 1 million of franchisee acquisitions this year, and we have an extremely strong pipeline of franchisee acquisitions. Dare I say it's sort of at a very similar level to 2019. So we are really pushing for a sort of result on franchisee acquisitions of between 5 million and 6 million this year, but that's whether we do that is yet to be seen. On corporate M&A, clearly I can't say about a pipeline for corporate M&A, but what I can say is that we're acquisitive, strong balance sheet. You can see our net debt falling to almost a net cash position, and we do definitely remain acquisitive. David D has asked, where do we see the most growth coming from? I'd say really franchisee acquisitions, corporate acquisitions, and FS are the three main areas. And then other areas of growth will be Mr. and Mrs. Clark and recruitment across the other brands, as well as organic growth in lettings across franchisees who are involved in the letting side of the business. So part organic, part acquisition. What's the possible, David D asked another question, what's the possible growth in financial advisors? So there is really no ceiling. I mean, I'll be pretty happy this year, and I think it's a realistic personal target to have. If we can get to sort of 300 advisors by the end of this year, that would be such a good result, David, and that's something that we've personally targeted ourselves to do. It is early days. We're at 250 at the moment, but we just see FS as a land of opportunity. David also asks, is the company? I have smiled at this one. Is the company planning on staying an AIM-listed company? Yes. Scott M has asked, can we tell me the reason that we took back the 4 London franchisees in October? Yeah, I mean, sometimes a relationship with a franchisee just doesn't work out for different reasons. And rather than sort of talking about the specific scenario, if we're not happy with a franchisee from a compliance perspective and we've tried everything, then ultimately we can't continue with that relationship. And likewise, if a franchisee is so desperately unhappy with being a franchisee, as I mentioned earlier, they can also exit by means of either a resale or a handback. So although it's a handcuff, if you like, a franchise relationship is a pretty solid one. That there are ways out of the arrangements if one side or the other decides to utilise the exit arrangements, either selling or sort of handing back, for example. In extreme circumstances, we will terminate a franchisee, and we have terminated franchisees if we're not if they're not meeting their obligations, which I'm sure you understand. So we had a second question about sort of the 25, 26 years of growth. So I'm going to skip over that one. So Peter W has asked, he said, can I congratulate everyone involved in the company for delivering excellent results? Secondly, can I ask whether there are specific regions or areas of expertise that you would like to be represented and are currently not? And that's a nice question to ask, because it's sort of the way I would answer that, Peter, is that I think we've got such a skilled team of people, and we've got a very skilled board. Most of us have got huge depth of property experience, and if we haven't got property experience, they've got experience in something else that we need as a business. And then below us, we've got about 15 sort of operational directors who are just fabulous, some of whom have been with me for 15 years. These people really do know their stuff. So expertise, we've got it. We have, however, made 2 board appointments that you may have noticed in the last few months. The first one was Michelle Brooke, who joined the board. She's the lady who grew the original FS business that we acquired in 2017, and she heads up our entire financial services division. Having Michelle on the board is just an obvious move. She's enjoying it. It's good for her development. It means we've got true board representation from the FS side of the business, and it just shows very clearly that we see that as an area for growth. And then the second board appointment, if you ever followed Telford Homes, Telford Homes is very successful, sort of grew profits from 3 million to about 30 million, and Telford Homes had been through that cycle of sort of being a 50 million market cap, 100 million, 200 million. We wanted to bring somebody onto the board that had been through the journey of taking an AIM-listed business from 100 million market cap to a 200 million and beyond. And we appointed John Stefano, who is the current CEO of Telford Homes. He's now on our board as a NED. He starts 1st of April. He brings with him vast development and build-to-rent experiences. So we've sort of added to our skill set. So that's the end of that question. Henk has asked, assisted acquisitions program, target sort of 5 million sales contribution per annum implies, and what Henk's saying is that, if we're saying we want to target 5 million of extra revenue coming on board by means of acquisition, franchisee acquisition, this implies sort of 20 to 25 deals annually. Is this a feasible target for this year? I think it is, Henk. I think it's feasible. We can't make any promises clearly, but I do think it's a feasible target. I'll be disappointed if we don't get it, and I'll be over the moon if we do. But as I say, I mean, that's quite a tall order considering we did 1 million last year, and we've got to rebuild the pipeline. But we've done it before. We know how to do it. I've still got the team in place who delivered the previous results. We stood firm with them over two difficult years. So yeah, I think it is feasible. John D has asked whether Belvoir intend to become involved in build to rent. We would certainly like to, and that part of that I think I answered in the previous question with bringing John Di Stefano onto the board. He does bring build to rent experience, and it's certainly an area that we will be looking at in the future. And I think I'm down to the last question. So this one. This one is from Henk. So does your risk-off acquisition strategy on corporate level imply that we're not typically... In fact, I've lost that one. Oh, Mark, the question I think disappeared then. Could I have it back if you... Oh, in fact, no, I can see it. Sorry, everyone. I've got it. Let's have a look. So the question is, does our risk-off acquisition strategy on corporate level imply we're not typically in the market for troubled estate agents, e.g. Foxtons? Henk, I did smile because we can't possibly comment on another listed business. But I think in general terms, I think one of the questions earlier was, could we run a corporate business? And yes, we could, was the answer earlier, and I sort of stand by that. Are we in the market particularly for looking at other, listed estate agency business? Not particularly. We want to stick true to core franchising if we can, but we are very open-minded, and can't maybe watch this space in the future.
Dorian, as usual, you're very generous with your time. In fact, you've taken every single question from investors that's come through. So if any more do make themselves available to us, we'll obviously provide those to you after today's meeting. Louise, thank you as well for your time and for updating investors this afternoon. Dorian, I'm shortly going to redirect investors to give you their thoughts and expectations and their feedback. But before doing so, I wondered if I may just ask you just for a few closing comments to wrap up with, and then, as I say, investors will be able to give you their feedback.
Yeah, I think really just thanks, Mark. I think really just to thank investors. Some of the names that I see, coming through are people that we've dealt with for a number of years. Investors have been very supportive, and I know that you're very pleased with sort of share price performance in general. We've also increased the dividend this year by 18%, and we sort of have committed to a progressive dividend policy going forward. So we're in a good position. We're still very keen to grow the business, as you can see from the strategy, and one of the positives that I take away from all of this is that to continue our growth, we don't actually have to do anything completely different. We already have the sort of pillars of growth. We just need to continue developing these pillars that already exist. So yeah, I'm very pleased with last year, and we're back at it again this year.
That's great, Dorian. Louise, thank you very much indeed once again for updating investors this afternoon. Can I please ask investors not to close this session, as we're now automatically redirect investors for the opportunity to provide your feedback in order that they can in order that management can better understand your views and expectations. This only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Belvoir, I would like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good afternoon to you all.